You built a business by making better decisions than your competition. But right now, at 11 o'clock at night, you are staring at a candlestick chart trying to decide whether to sell a position you barely understand based on a headline you read 30 seconds ago. That is not investing. That is expensive gambling dressed up as discipline. Here is what the data actually shows. The average active retail investor underperforms the S&P 500 by 1.5 to 2 percentage points annually. Not because they lack intelligence, because they are human, and humans panic, hesitate, overtrade, and confuse movement with progress. The market does not reward effort, it rewards process. Robo-Advisors are not a product for people who do not understand finance. They are a tool for people who understand opportunity cost. An algorithm does not have a bad quarter. It does not read a fear-driven headline at midnight and make an emotional exit. It executes a defined strategy every single day without deviation. The process begins with a psychometric risk assessment, a structured questionnaire that maps your actual financial profile. Your time horizon, your liquidity requirements, your genuine tolerance for drawdown, not the tolerance you think you have during a bull market. The algorithm then constructs a portfolio aligned to that profile and manages it autonomously from that point forward. One of the core functions is automatic rebalancing. As markets move, your asset allocation drifts. Equities outperform and suddenly represent 60% of a portfolio designed for 50. A robo-advisor sells the excess automatically and reallocates into underweighted assets, systematically selling high and buying low with zero emotional friction. No decision fatigue, no hesitation. The second function is tax loss harvesting. When positions decline in value, the algorithm sells them to realize the loss, immediately reinvests in a correlated asset to maintain market exposure, and uses that captured loss to offset taxable gains elsewhere in your portfolio. In a high-income year, this single feature can recover a significant portion of its own cost. It is fiscal optimization running silently in the background while you focus on your business. Now consider the cost structure. A traditional human financial advisor charges an average of 1.5% of assets under management per year. A robo-advisor charges approximately 0.25%. On a $500,000 portfolio, that differential is $6,250 annually. Compounded over a decade, the drag from fees alone erodes a substantial portion of your long-term returns. Lower cost is not a minor detail. In compounding environments, cost is destiny. Here is the real argument. Your highest return activity is not managing a portfolio. It is building the asset that generates the capital in the first place, your business. Every hour you spend analyzing positions, rebalancing manually, or second-guessing your allocation is an hour not spent on client acquisition, product development, or operational leverage. That is a measurable opportunity cost, and most entrepreneurs systematically ignore it. The most capital-efficient decision you can make in 2026 is to delegate the management of your wealth to a system specifically designed for that function, and redirect your cognitive bandwidth toward the business only you can build. Automation is not a shortcut. It is a strategic allocation of your scarcest resource, your attention. You systematized your sales process. You automated your operations. You delegated tasks that did not require your direct input. The question is not whether you should do the same with your investment portfolio. The question is why you have not done it already. Automate the wealth, scale the business.